Welcome to the Businesstalk podcast. I am your host Deepak from India. Today we have the privilege of welcoming Emeritus Professor Lawrence H. White as our distinguished guest on the podcast. Professor Lawrence White is an American economics professor who recently retired from George Mason University, where he taught graduate level monetary theory and policy. He is a leading scholar of banking and monetary economics, with expertise spanning the theory and history of money and financial institutions. He has held teaching appointments at New York University, the University of Georgia, and the University of Missouri, St. Louis, and is widely known for his influential books such as The Clash of Economic Ideas, The Theory of Monetary Institutions, Free Banking in Britain, and Competition and Currency. In addition to his authored works, Professor White has edited major collected volumes, including The History of Gold and Silver and Free Banking, among others. His research on monetary theory and banking history has appeared in top journals, including the American Economic Review, the Journal of Economic Literature, and the Journal of Money, Credit, and Banking. He received the Adam Smith Award from the Association for Private Enterprise Education in 2014. Professor White's visiting roles include research fellowships and scholarly appointments with the American Institute for Economic Research, the Swiss National Bank as visiting lecturer, and the Federal Reserve Bank of Atlanta as visiting scholar. He also contributes to the field as a co-editor of Econ Journal Watch and as a board member of Associate Editors for the Review of Austrian Economics. He served as a distinguished senior fellow with the F.A. Haig program at the Merkis Center, George Mason University, and as a senior scholar at the Cato Institute's Center for Monetary and Financial Alternatives. Dr. Lawrence White earned his BA from Harvard University and his PhD from the University of California, Los Angeles. In today's episode, Professor Lawrence White discusses key insights from his acclaimed book, Better Money, Gold, Fiat, or Bitcoin. Let's not keep you waiting. Please join me in welcoming Dr. Lawrence White to the conversation. Professor Lawrence, thank you for joining us. It's truly an honor to have you on the Business Talk today.
My pleasure. And I should mention that I'm in India right now. I'm uh, visiting family, and I'm in my sister-in-law's house in Gurgaon.
Very nice. Excellent. Thank you. Welcome to India, Professor.
Thank you.
Professor, your book frames the discussion as gold, fiat, or Bitcoin as standards. What do you mean by monetary standard? And what makes one better than another?
Well, the monetary standard means the basic money in a system. So examples are the gold standard, where the basic money is a gold coin. Today we have fiat standards, where the basic money is a unit of central bank liabilities. They're called liabilities, although they're not redeemable for anything else. So a fiat money unit is a money by decree. And the third alternative I discuss in the book is a Bitcoin standard, which is uh, a possibility. It's not yet in actuality, but if people made payments in Bitcoin and denominated prices in Bitcoin, and if banks operated with Bitcoin as reserves, then that would be a Bitcoin standard.
Professor, you emphasize using simple supply and demand reasoning. What's the most important supply and demand insight that help listeners understand money systems more clearly?
So a gold standard is sometimes misunderstood by people who think that it implies a a vertical supply curve, a fixed supply of monetary gold. And I point out that in fact, there's some elasticity in the supply of gold, even in the short run, because there's non-monetary gold. And I'm sure you're aware, everyone in India has gold jewelry. And at a high price of gold, people will melt down some of their gold jewelry, and that can be coined, and so provide more basic money to a gold standard system. And in the long run, the supply of gold is quite flexible, elastic, as economists say, because a rise in the purchasing power of gold will increase gold mining activity. It will incentivize gold mines to dig a little deeper do a little more exploration, use more expensive methods for extracting gold than they were using when the value of gold was less. And this means that in a gold standard, the quantity of money responds to changes in the demand to hold money. Just as any individual can provide themselves with more money, a nation as a whole can accumulate more money under a gold standard by importing it from the rest of the world if it doesn't have gold mines, or by accumulating the output of gold mines if it has gold mines. Whereas, by contrast, under a fiat standard, we rely on the central bank to provide more money when more money is demanded, and they may or may not respond to that demand in an appropriate and timely way. Sometimes they overdo it. In a Bitcoin standard, we have the other extreme where the quantity of money is predetermined by the Bitcoin program and has absolutely no response to changes in the demand to hold money. And that is why the price of Bitcoin is so volatile.
Professor, if you strip away the slogans, gold is stable, fiat is modern, and Bitcoin is the future, what are the actual mechanisms that make each standard self-correcting or not when money demand suddenly jumps?
So in a gold standard, when money demand suddenly jumps, that will raise the purchasing power of gold, how many baskets of goods you can buy with an ounce of gold. That will incentivize people to melt down some of their non-monetary gold. In the gold industry, they call it recycling. And I used to think it might be a trivial amount that people will recycle, but according to the World Gold Council, it's about a third of the supply of new gold that comes on the market is coming from recycling. And especially when the price is up, you see places advertising more urgently, "We buy gold." We will turn your unused gold into cash. And so that will increase the supply of money to meet some of the increase in demand. The purchasing power of money will still rise, but not as much as it would if the quantity of gold was completely fixed. And then in the longer run, as I said a minute ago, it will incentivize more gold production from gold mines. And so over a 10, 20, 30-year horizon, the purchasing power of gold is quite predictable. It will come back to its long-run trend. And we see that in historical data on the price level under gold standards, where the price level, how many units of money it takes to buy a basket of goods, is the inverse of what I'm calling the purchasing power of gold, which is how many baskets you get per ounce of gold. So that's a desirable feature in that it makes the purchasing power of the monetary unit more predictable, at least at medium to long horizons. And that's helpful because it means you can make long-term contracts. You can have long-term rental contracts. Businesses can issue long-term bonds. In the 19th century, railroad companies were issuing 50-year bonds, sometimes 100-year bonds. Nowadays, no company issues 50 or 100-year bonds because the purchasing power of money is not predictable enough, even in dollars. I haven't studied this, but I imagine that in rupees, corporate bonds are even shorter than they are in the US. So that helps long-term planning and investment in an economy. In a fiat standard, it's up to the central bank, as I said, to determine the quantity of money and thereby regulate the purchasing power of money. And in theory, in principle, if they could predict accurately changes in the demand for money and meet them immediately and in the right magnitude, a fiat standard could be more stable in purchasing power than a gold standard. But in practice, that hasn't been the case. In practice, we've had higher inflation everywhere in the world. We've had higher inflation under fiat standards and under gold standards, although, of course, some currencies are more stable than others. But we've had, of course, double-digit inflation in some countries, triple-digit inflation in some countries, hyperinflation in some countries. That's impossible under a gold standard. So that's another advantage of a gold standard. It limits the rapidness with which money can be created.
Professor, you challenge the claim the gold standard caused the Great Depression by arguing the interwar system wasn't the classical gold standard and central banks block adjustment. What's the most decisive piece of evidence or logic that flips the mainstream story?
A colleague of mine used to quote or paraphrase Shakespeare. In one of his plays, Shakespeare says, when two men are riding on a horse, one of them has to sit in front and hold the reins. And so when we had central banks running the gold standard uh, in the First World War and the years after that, it was central banks who were holding the reins, who were determining what was happening to the quantity of money. Uh, and the Great Depression in the interwar period, I blame on bad monetary policy by central banks. In the 1920s, they were too expansive. In the 1930s, they were not offsetting the collapse in the quantity of money, which they could have done and were supposed to do according to their mandates. And so you can't blame the classical gold standard because that wasn't what was running things. So if you go before the First World War under what was called the classical gold standard, there's no Great Depression, there's no collapse of the money supply. And if you really want to dig into it, the deflation of the 1930s was made necessary by central bank policies during the First World War. They expanded the quantity of money in every country that was participating in the war uh, more than was consistent with keeping the value of money the same. And so there was high inflation in all these countries. And so the value of the pound sterling or the dollar or the franc fell relatively to the value of the gold pound or the gold dollar or the gold franc. And after the war, a country that tried to go back at the old relationship, the old parity, for example, Great Britain, they had to bring their price level down quite dramatically to make the purchasing power of the paper pound consistent with the purchasing power of the gold pound. And that forced a big contraction in the economy. And of course, Great Britain gave up the attempt to go back to gold early on. But the interwar period was a mess due to the hangover of the bad policies, the inflationary policies during the First World War.
Professor, when you explain how a fiat standard works, what do you see as the central trade-off between flexibility, policy discretion, and the risk of inflation outcomes?
So a fiat standard means that you have a central bank that controls the quantity of basic money, dollars in the US, rupees in India, and the central bank balance sheet contains the reserves of the commercial banks. And so if the central bank expands, now the commercial banks are in a position to expand. So the central bank is determining the overall quantity of money. The commercial banks are more or less passive in this process of expansion. And as I said, if the central bank would moderate the creation of money and just meet changes in the real demand to hold money, it could work quite smoothly, but it's very difficult for them to forecast. And so in a way, they're trying to do something nearly impossible. And in practice, they've tended to overexpand, which creates a unsustainable boom in the economy, which then will taper off or collapse. And so we get a boom bust cycle. And in recent years, central banks have committed themselves, at least on paper, to inflation targets in many countries, but they haven't been really held accountable for missing their inflation targets. So it turns out not to be very effective in practice. So in the US, in the pandemic, we hit 9% inflation, even though our inflation target was 2%. In Europe, they hit 10%. And they're very slow to bring inflation back down to what was supposed to be the target. And that means people issuing 10-year bonds can't really predict what the value of the dollar or the euro is going to be 10 years forward, because a rise in inflation is not going to be offset. So that's the problem of a fiat standard. The quantity of money is unpredictable, and the central bank can deliberately or accidentally create more money or less money than is consistent with just satisfying people's demand to hold money.
Professor, the recent rise in inflation in major currencies help rekindle this debate. What do you think that episode taught the public about the strength and weaknesses of modern fiat money?
Well, there is the view that prices are rigid downwards. You can't get workers to accept lower nominal wages. And so a little bit of inflation helps lubricate the system. But I think it's really begging the question. The degree of rigidity in prices and wages depends on what regime people live in. They understand that if they ask for a continually rising wages in a system where the purchasing power of money is stable, they're going to price themselves out of the labor market. And so you don't get as much rigidity, you don't get as much stickiness of prices and wages in a monetary standard like the gold standard that keeps the expected rate of inflation close to zero, whereas and dependably close to zero. Whereas under fiat standards, although the official target is 2%, we all know it could be higher, it could be slightly lower, but mostly it could spike and then will take a long time to come back down.
Professor, your book evaluates how different standards respond to shocks. Could you
Right.
compare how gold, fiat, and Bitcoin style standard would react to a sudden surge in money demand and a negative supply shock?
So the one advantage of a Bitcoin standard is that it doesn't have supply shocks. The supply is completely predetermined. However, it does not at all respond to demand shocks because of the predetermination of the quantity of Bitcoin. So that would make it a system where the purchasing power of money is subject to big drops. And compared to a gold standard, which has a certain natural elasticity of supply in response to demand, I consider that a big disadvantage of Bitcoin. And a reason why people haven't flocked to Bitcoin, even though it's available, people are not much using it as a medium of exchange, that is, to buy things. People speculate in Bitcoin, but the vision of Satoshi Nakamoto was to have a new world monetary standard, and that is not happening. Although people have invested in Bitcoin, they haven't been buying and selling in Bitcoin. And that's the real challenge facing people who want Bitcoin to move beyond where it is now, who want it to be more widely adopted as a money. It doesn't respond to demand shocks, and therefore the price is very volatile. The purchasing power is very volatile. And it means people aren't going to adopt it to hold their rent in, at least until their rent is denominated in Bitcoin. It's very risky to hold your rent money or your utilities money in Bitcoin. In a fiat standard, we're at the mercy of the central bank as to how it responds to money demand shocks. And when it comes to shocks to the supply of goods, central banks shouldn't respond. And yet they sometimes do, which, for example, let's say there's a spike in the world price of oil. That's a negative supply shock to any country that imports oil. That will put upward pressure on prices in that country. If the central bank wanted to keep inflation down in the face of that, they would have to tighten money. So that's a double whammy on the economy. On top of a fall in the availability of oil, we're now tightening monetary policy. It would be better for central banks to aim at stability of total spending in the economy, sometimes called a nominal GDP target. But central banks have not been persuaded of that, so they're sticking with inflation targets. And as I said before, inflation targets that are not very strict. So in a gold standard, as I've said before, the response to money demand shocks is entirely in the right direction. Now, you can complain that it's not fast enough. And there is a possibility of designing a cryptocurrency that would work like a gold standard, but faster to respond to money demand shocks. I'm actually consulting with a startup which is trying to design and launch a currency of that kind. And it's an uphill battle to get widespread adoption, but we'll see if anybody finds that a worthwhile project.
Professor, in discussing Bitcoin as a potential standard, what has to be true economically and institutionally for something like a Bitcoin standard to be more than just an investable asset and actually function broadly as money?
Well, in a way, I've addressed most of that question. If there were a complete breakdown in fiat money standards, it seems to me it's more likely that people would go to a gold standard. It has a track record. It has wide distribution of gold around the world. More people own gold than own Bitcoin. And it has a history of serving as money. But if for some reason gold was unpopular or government somehow prevented it, then you can imagine people going to a Bitcoin standard. One of the problems right now is that there really isn't any Bitcoin banking. There are some projects which try to make Bitcoin easier to spend and to receive, and lowering the cost of using the Bitcoin blockchain. They haven't led to much adoption of medium of exchange adoption of money, of Bitcoin, sorry. But you can imagine in a world where all the fiat currencies explode and for some reason gold is prevented from becoming money again, a Bitcoin standard, but it would be a very volatile standard. Let me give you an example. Under the classical gold standard, when a new country decided to join the gold standard, let's say Germany in the 1870s, they would sell off their silver coins and buy enough gold to replace silver coins with gold coins. So that's an increase in the world demand for monetary gold. That raised the purchasing power of gold slightly. That stimulated more gold mining. And within 20 years or so, the blip and the rise in the purchasing power of gold had been reversed. And so it wasn't such a consequential event. Whereas under a Bitcoin standard, if some country switches to the Bitcoin standard, that will spike up the purchasing power of Bitcoin. And there's nothing to reverse that because there's no response from the supply of Bitcoin. And so the price level, the purchasing power of money is much less predictable. And that discourages long-term financial transactions. So we have yet to see much financial contracting using Bitcoin as the medium of repayment. It's just too volatile. Nobody wants to borrow money with an obligation to repay Bitcoin. It's too risky.
Professor, to conclude this episode, I would like to end with a final question. If we imagine a serious future inflation crisis in major fiat currencies, and people actually start switching at scale, what makes you think gold is more likely than Bitcoin to become the better money, and what would have to be true for Bitcoin to win instead?
Well, I'm kind of repeating myself, but gold has a more predictable purchasing power. More people are familiar with it. Everybody's seen a gold coin, even if they haven't handled one. But a gold standard with, uh, wouldn't involve people handling gold coins, 18th century, 17th century technology. It would involve banks, as today, people transferring bank account balances. The difference would be those bank account balances would be redeemable if you wanted it. Most people wouldn't want it for most purposes. They would be happy to use bank issued money, and bank issued money gives an additional flexibility to the quantity of money. But redemption for gold pins down the purchasing power of bank issued money. Banks cannot arbitrarily expand their liabilities, and the purchasing power, as I said, is pretty predictable at longer horizons. There is currently crypto gold available as an alternative to people who want to invest in gold. And if the issuers of these are claims to gold that you buy and sell on crypto exchanges. So Tether Gold is one and Pax Gold is another. If those gold claim issuing institutions would make their accounts transferable at low cost between their customers or across platforms, then it would be quite to use gold-denominated crypto claims. We could also have, ordinary, old-fashioned banks with gold in the vault where you write a check, gold, the bank you have your account at to the bank that receives the check. So that could all be reconstructed simply by switching from a fiat basic money to a gold basic money. So one step would be officially converting fiat monies into gold monies. If governments don't want to do that, then it's up to the public to put themselves on the gold standard or the Bitcoin standard, as you suggested. But as I said, for that to happen, there has to be something blocking the use of gold, which it seems to me people would prefer. Now, I might be wrong about that. So I'm all in favor of letting people use Bitcoin, letting them choose. It's just my prediction that they would prefer under these dire circumstances, gold denominated money to Bitcoin denominated money. So I think for Bitcoin to take the place of fiat money would require not only a collapse in fiat standards, but somehow a collapse in the gold market or some strongly enforced measures to prevent people from using gold.
Professor Lawrence, thank you again for joining us on Business Talk and for such clear, grounded discussion on what makes money work, where we are talking about gold, fiat, currencies, or Bitcoin, and how each framework responds to real-world shocks and trade-offs. I also appreciate how you encourage our listeners to move beyond slogans and evaluate monetary standards using simple economic reasoning and historical evidence, so the comparisons are informed rather than hype-driven. Professor White, it's been a privilege. Until next time, this is Business Talk and Deepak Bhatt. Thank you and goodbye.
Thank you.